third trading day in the week. Of course, a bit of a summary. Let's have it up for you here. 1.26% was what we did on Tuesday. Yesterday, the market was a little bit sluggish than that, but we still finished off in the green. The market crossed the 38,000, where it hanged in there on Tuesday. So we're just about 150 basis points above a Tuesday market level, 0.38%. Market cap now effectively above 13 trillion naira. In terms of volume, the market was about 120 higher than on Tuesday in terms of the first line there. Then in naira value, we're just a few billions also higher than what we finished off on Tuesday. Those are market figures for Wednesday. And the number of deals were just shy of Tuesday, about 5,000 transactions. The banking sector was about 0.1% in the green. The consumer goods still piping really hot, 1.5%, technically speaking. Industrial goods remain a little bit underwater in the red. Insurance followed their cousins to the north. That's the banks. And you have the oil and gas aching at about 0.01%. That's 0.1%, less than that. Of course, again, because of that share price gain by Wando. Move on to the unlisted securities market, and you can see the NESD over-the-counter market a little bit unchanged. It was a very positive Tuesday, but that was largely sluggish on Wednesday. If we roll that over and bring in the Treasury bills market and the Naira bond, these guys are the ones in the news today. The Treasury bills. That's the Treasury bills maturing on the left side of your screen. You can see the numbers there between now and October. And that's quite aggressive, 180 billion naira in total. That's via the FMDQ OTC Securities Exchange alone. Of course, you also trade bonds, bonds only, on the Nigerian Stock Exchange, but that's the bond market for you there. A bit of a summary of the most actively traded papers for the third day in the week. 11.9 billion naira in total in 80 transactions. Let's go to the currencies market. The naira was a little bit flat, 0.02 against the dollar, 305.55. The central bank referenced spot FX market. At the interbank market, it was about 0.4 ahead the dollar, a negative 1.24% on the pound, and the euro a massive 6.74% gain, 3898.90. Then at the parallel market, what we call the street market, it was all flat. You can see the numbers there. And finally, you find the FMDQ investors and exporters window. The naira gained nearly 0.2%, 0.2%, to finish at 367.50. Let's return to the banks. They are the big ones on our markets, of course. So let's bring in the research analyst in charge of financial services at Kodros Capital, Oluwasegun Akinwale, to this conversation. Good morning.
Good morning, Boston.
It's good to have you.
Thanks.
Okay. Let's stick to tier one banks. Let's talk to the big five. But before that, broadly speaking, where are we as far as the banks are concerned?
To a large extent, what we used to see in the financial services system, especially the banking sector, has significantly changed from where they were last year. Last year, we were having the issues around non-performing loans, around capital adequacy ratio going below the regulatory requirement. But this year, we've seen a bit of change in what the financial services used to be like last year. We've seen a lot of issue around reclassification of loans, around the issue around Focados coming back online, which used to be the pressure on the bank's MPL in the previous year. So a lot of these issues have kind of redefined what the banking sector is looking at in 2007, and we've seen that going into the rest of the year for the banking sector. Apart from that, on profitability, we've seen what the banks have done for the year 2016, what they've done in Q1 2017. And we still expect that to flow into what, even if without much deviation from what they did in Q1 2017, we'll still expect that to flow into what they're going to do for Q2 2017 and for the rest of the year. So for the banking sector as a whole, especially the Tier 1 bank, we still see a lot of gains in those stocks.
There were a lot of apprehensions last year about these big banks, and Nigerians were all on the edge of our seat whether they will be sunk via FX, via non-performing loans in the oil and gas, power sector, and what have you. Do you think the bad days are over? Is that what your report, Controls Capital report, revealed?
To a large extent, the bad days are not over. They still have issues, but for this year, we're expecting this to moderate. For the Tier 1 banks, take an average of the Tier 1 banks MPL. You're looking at, for Q1, you're looking at around 7.76. But if you go into the year, we are looking at this moderating to around 6.6% for the rest of the year 2017. And these are the result of, we're seeing a lot of reclassification in the low and non-performing loans of most of these banks. According to the conference call of FBNH last week, they clearly stated that they reclassified some loans worth around 150-something billion in bad debt. So a lot of this is going to also reflect in the like of GT, RSS, UBA, and what we're expecting for these guys to really do. So a lot is going to see some declassification, and this is a result of what we are seeing for Focados coming back online. Some exposure within that segment is being arrested. Also on the issue of Salat, you've seen the federal government, the Apex Bank stepping in to caution the effect of what that might result in the banking sector. So a lot of that is what is the banks, people are seeing in the banks, which you've seen the rally in the last few weeks. Year to date is already doing above 41%, still leading the bank, still leading the gainers list. So the banking sector is currently defining itself. Compared to what we saw in 2013, where the oil and gas sector was doing about 122% year-on-year gain, the banking index was doing around 31%, while others. But you've seen that redefined with what we are seeing in the oil and gas space and what we are seeing in the banking space. The banks essentially will still, even if banks are not lending new loans due to the situation of the environment, who do you want to give the money to? You see them doing a lot in fixed income securities, taking a lot of benefit from what the government is doing, from what the interest rate environment is doing. So the banks are still going to position well for the rest of the year and do a lot of profit. The profitability is still on the good side. That's
one. But again, regulators and oversight institutions never let the banks feel free at any point in time. So there is IFRS-9 due January next year. That's additional hurdle for local banks, or at least these big five to cross. How do we think, what's going to happen?
Not just the big five. When it comes to IFRS-9, it's going to be a broad adoption by all the banking sector, the Tier 1 banks, the Tier 2 banks. For the Tier 1 banks, the issue around IFRS-9 to a large extent is more like early recognition of impairment losses. It's a forward-looking provision that makes you make provision based on expected credit loss, not when